Our next guest says that a market correction is coming in the second half of the year. Barry Bannister is chief equity strategist at Stifel. And Barry, we've watched so many swings over the last several months, back to those new highs, basically, for the markets. What makes you think a correction is coming in the second half?
Yeah, we weren't too worried about the geopolitical risks, so we knew that it wasn't in Iran's best interest to block the oil flow to, which is its only source of money, to its only client, which is China. So what we've been focused on is the economy. We think there's going to be a consumer slowdown, and you'll see some data on that Friday with personal consumption. As the consumers pull back, precautionary savings go up, consumption slows. And that's 68% of the economy. Also fixed investment, which is capital spending, both houses and businesses. That's also going to be about down, and it's going to be about 18% of the economy. So it's going to prove, I think, that big tech is cyclical. They are exposed very much to the top line growth and to the consumer. And the consumer is going to take a little bit of a break here. So that usually results in a pullback in the market. Nothing dramatic, maybe half the magnitude of what we saw January to April.
So President Trump is pushing the Federal Reserve once again to cut rates. He's saying now that he'd like to see 200 to 300 basis points of a cut. I don't know if that's more of the art of the deal, just trying to spur them into cutting anything at this point. But it sounds like you're in the camp that thinks that rate cuts should come sooner rather than later.
No, actually, I think the Fed already cut, in the sense that when you raise your inflation target by, almost a percentage point, and you don't raise rates, you're effectively lowering the real or after inflation rates. So real rates actually are falling. So the Fed is actually standing aside. They probably should be hiking rates by next year if this economy just keeps cooking on. But we think it's going to cool off. There are consequences to imposing fairly large tariffs. Those will flow through the economy more in the second half than the first half. And I mentioned the other issues, which is the top line sensitivity to the consumer pulling back of the big tech companies. It's a widely underappreciated factor in the market.
But if you think the economy is going to cool, you must think that inflation is going to come in hotter than anticipated, too, if you don't want the Fed to cut rates from here.
Yeah, Becky, we talked about stagflation more than 6 months ago. It's not like the 70s. I remember the late 70s. Chair Powell is 7 or 8 years older than me. He remembers them even better. But no, it's nothing like that. It's just a cooling off of GDP, a mid-cycle, late-cycle slowdown. We had 3 of them between 2010 and 2019. Each time the year-over-year S&P 500 was down 5% year-over-year at a point when that happened, which would put us in the mid-5,000s for the S&P. But also, it's a cooling off of the economy with inflation heating up. Over 3%. On the core is going to be outside the Fed's comfort zone. So you won't hear any dovish language coming out of the Fed if we're pushing inflation higher.
Yeah, I don't know. I don't think that's coming. But your 5,500, we've been talking to you a lot, Barry. What did you have that on January 1st of this year? You have 5,500 for the S&P. This is an old call, right? Or is this totally revised after what's been happening?
No, it really hasn't changed much.
That's what I mean. So we got 4,900. So we flushed that out. So now we're all the way back to 6,100 almost. And so now it seems like you haven't revised anything. So that first sell-off of 20%, that didn't do it for you. That didn't flush anything out. You think you're going to stick with your year-end or third quarter target of 5,500, even though the round trip all the way to 4,900 back to 6,000 has already been made?
Typically, Joe, what we see in these pullbacks is the first one and then the echo of the first one, the second one. The economy itself has done fairly well up to this point, and now it's starting to teeter. There are consequences to some of the actions that have been taken, like tariffs. And so the first one was the fear and expectation. The second one is the reality.
Yeah, but there's no way that you would have thought that it would have happened this way. When you said 5,500 at the beginning of the year in the third quarter, I mean, you had no idea it was going to go down to 4,900 first, come all the way back to 6,000, and then end at your 5,500. Did you? That would have been fun to play that if you could have.
Yeah, it's been a trading type of market. In fact, the big tech names got absolutely clobbered between January and April. And then, of course, they rebounded, but they haven't re-achieved the old highs, particularly the ones we're focused on. And so it's more of a pullback, sideways, zigzagging market, a market that's digesting massive change coming out of Washington. And we do look for it to end the year around 5,500. And that's going to be tough to swallow because we started the year at closer to 6,000, around 59. Right.